Hi there, I'm Mark Sebastian, and this is Butterfly Intensive Part 1. Reminder, this is for educational purposes only. Now, this should be considered investment advice. Consult your financial professional. Options have risk. So, what are we going to learn? You're going to learn what is a butterfly, what are the Greeks of the fly, basic setup, setting up a directional fly, hedging the fly, picking the right strikes, setting up a broken wing butterfly, and some additional management techniques. So let's take a look at two spreads and compare the two of them. All right, this is spread 1. All right, so what do you notice about spread 1? Well, it has a lot of risk. As you can see, it could lose $180,000. But what I really want you to pay attention to is the Greeks here. So it has negative gamma of 11. It's in the S&P, so you expect it to have a lower gamma. All right. You have a high theta, $700 a day. That's really high. And a huge, bigly short Vega position. Bigly. And as you can see, you want really nothing to happen and time to pass. That's how this spread makes money. And as you can see, this was from March 10th. If we were still 2370, this position, which appears to be expiring this week, would be doing well. All right, so now, here is spread 2. Well, let's talk about this spread. What do you notice that's a little different? Well, the negative gamma has been cut in half. 1 second. So it has this lower, as I was saying, it has this lower gamma, and then it has a theta. So the gamma is about half, and the theta, if you look, is about a third. So let me go snipping here. Let me kind of show you. We can actually look at the difference in the thetas here. In fact, we will in a second. All right. So you can see that the theta is about a third, 700 versus 251, and the Vega is less than half as well. So a huge change. All right, so what are the two differences? The two spreads share similar Greeks. They're short gamma, short Vega, long theta. What is the main difference? The severity. The severity is the big difference. All right, and so one is a more extreme version of the other. All right, so now we can really look at them. All right, with movement, and I think this is really the key differences here. All right, so you've got less severe Greeks at the money, right? Half the gamma, a third of the Vega, a third of the theta. But now take a look at what happens if we move a lot. Down 4%, what does my position look like? Well, in spread 1, I've gotten along 800 deltas. I've had a big, huge delta change. I'm still short a lot of gamma. I'm collecting theta, and my Vega is now negative 2,500. Meanwhile, in my other spread, my delta is only a quarter of what it was up here. I'm no longer short gamma. I'm actually paying theta, and my position is actually long volatility exposure. That's important. So if you think about it, a butterfly or an iron butterfly is just a straddle that's hedged. All right. That's all. So spread 1, straddle. Spread 2, iron butterfly. So a butterfly or iron butterfly is really, and I mean this, all it is a butterfly that's hedged. Is a straddle that is hedged. All right. So a straddle is the sale of a call put on the same strike. All right. And an iron butterfly is the sale of a call and put at the same strike hedged with long options at the extremes. All right. So while we tend to never trade straddles here at Option Pit, we don't. All right. And the main reason being there's a systemic risk issue that we're unwilling to deal with, and we don't like to put clients in front of. There's also margining issues. Unless you got a ton of margin, these are very difficult to trade. All right. So the big difference, but we trade butterflies all the time, and butterflies are basically straddles. And the big difference is that a fly is naturally hedged and a straddle is not. All right. One reason we like flies is what we call the sleep at night factor. All right. We can sleep at night because if we wake up and the market is down 10%, okay, down 10%, I'm really not losing any more money down here. All right. Meanwhile, down here, I'm continuing to get worked. Look at how much delta I have down 10%. Every point in the S&P, this position loses $1,000 at 21.35. All right, and then here, every point is $34. So you can see how minimal my threat is at this point. All right. So let's talk about some basic characteristics. A butterfly wants the underlying to stay in one place. Thus, it is short realized volatility, making it short gamma. A butterfly wants nothing to happen. All right. If nothing happens, then it makes money. All right. Thus, it is collecting insurance premiums. It means it's long theta. All right. And we'll go through this, obviously. The butterfly does not trade across many months, and it wants the perception of near-term movement to fall. That's what makes it Vega, short Vega. It collects premium, short Vega. And the fly is set at equal strikes, all right? And it's short the same strike and long equal strikes away. This produces a fly that is close to delta neutral, but tends to be short delta. All right, and this is because of skew. All right, so let's look at kind of how flies are put together. All right. So, let's play around with building we can build a little butterfly, right? As you can see, it's March. It's April 19th here. So let's just go to like something in SPX, and we'll go to like the May 19th. So about a month away. All right. So I want to kind of talk about how this thing moves. I'm just going to throw up some strikes. So there you have it. So, just looking at the basics of this fly, it makes a lot of sense. All right, so let's start with the short gamma. All right, what does short gamma really mean? It means you don't want the underlying to move very much. All right, and you can actually visually see that we don't want the market to move very much. All right, it's got a tight range. 2291 to, call it 2380, 2375. All right, it has a very tight range. That is the short gamma nature. All right, now short gamma, and you can see every day that time passes, this thing makes more and more money every week, every day. With time passing, the position works in my favor. That is the definition of long theta. All right, and then the Vega piece. All right, if I want movement to stop, all right, then I probably want the perception of movement to stop, except for if I'm within one contract. All right, calendar is a totally different scenario, but if I'm only trading within 1 month, and in this case I'm trading all in May, if I'm short gamma and long theta, then I am 100% short Vega. And in this case, I really want that perception of movement to fall. Right? And that's really what creates my spread. All right. And the final piece is delta, and we'll talk about that in a second. But they're relatively flat delta, although they tend to have some because of curvature. All right. And, what I would point out is that I set these guys up equally away. Right? They're $60 away. My puts are 1660 and my calls are 570. All right. My puts have a 26 delta. My calls have a 17 delta. That is what produces the short delta exposure. Right. That's how that entire process works. Pretty simple. All right, and you can actually see in the skew chart there's a lot of strikes in SPX now, or contracts. And you can see they are more expensive. Puts have a higher volatility. That pushes, volatility is a measure that goes into producing Greeks, pushes the delta higher. All right, if I wanted to find a 17 delta, I'd be buying the 2235. Huge difference. An extra 40 points. All right, now, let's talk about how to set up the standard fly. All right. The standard iron fly, you're going to want to set up short at the money, long wings. Right. Wing selection should be based on standard deviation. Right. Set number of days to expiration or the number of days one expects to be in the trade. Right. If you're guessing at how many days you expect to be in the trade, or you're or you're doing a weekly trade, you probably want to use trading days and not calendar days. If you are trading a block of time, then use calendar days. So how do I calculate standard deviation? At the money strike times the vol. Remember, vol is percent. Days to end of trade over total days in a year, and the square root of that. All right, so let's look at the days to expiration here. So I'll pull up a calculator. All right. We're looking at 22.35. All right, times that at the money vol is 1210. So times 0.1210. All right. And that'd be times 33 over 365. All right, and then I do the all right, so it'd be 32 divided by 365. Take the square root of that times my volatility, which is 0.121, and then I multiply that by 2335, and I got a standard deviation of 2.127. I think I have something wrong there. All right, so I'm going to try that one more time. 33 divided by 365 square root. I pressed the wrong button. Times 0.121 times 2235. There we go. 81 bucks. So if I wanted to set up my butterfly in all right, so if I wanted to set up my spread, all right, 33 divided by 365 square root times 0.121 times 2335. Yeah, 85 bucks. So, all right, so I knew I put something else in the wrong. All right, so it's 85 bucks wide. So instead of at the 22.95s, I want to be at the 24.10s. All right, and then I'd be doing the 50s. All right. Am I off by 10 on my calls? Yeah. I'm actually at the 24.40. So there is my butterfly. All right, now. All right, I'm going to give you one rule for this. All right, you want your upside call that you're setting up for your hedge to be worth at least 1.5% of the underlying. So in this case, I want something worth at least or you're at the monies. 23.35 times 0.015. Yeah, I mean 0.001. So 1/2. So really, what I mean is 1.5%. So it should be worth 350 is really what I mean. All right, should be worth about $3.50 at a minimum. So in this case, I would probably move my strikes to set this at 24.05 or 24.10. So I'm going to do 24.10, which means moving my strikes in. Why do I do that? Well, I want my out of the money call to have some value so that it's not just so that if the underlying rallies, it doesn't just die at the vine. It needs to have a little bit of value to it. Otherwise, it's just not going to work properly as a hedge. The Greeks are too unreliable. All right. That's really what it comes down to. So here's what this spread ends up looking like. All right. All right. A fly can be done weekly or monthly. All right. We do a lot of weekly little butterflies here at Option Pit. All right. It is easier to guess what is going to happen for the next couple of days in terms of volatility than it is for a long period of time. That's why I like trading weekly options so much. All right. A good fly is really only set to make money for a few days. All right. If you do a fly properly, you want to get in and out quickly. All right. Now you're saying, Mark, you've got this fly set up, and yet you've set something up that could potentially make or lose money directionally. This thing has a direction to it. Fair point. When setting up your butterfly, try and cut that delta in half. Right now, my delta is about 130. All right, so I can cut this down pretty easily by buying like 2 of the 23.75s. You don't need to cover all of it. All right. You don't have to cover all of it, but you can tell it makes a significant difference in how this thing performs. All right. Buy up to 3, and I'd still probably be fine. You can see I've really just removed the delta, and I don't have a lot of risk in the position anymore. So I generally like removing some delta. Now, an alternative to this is to do it a little broken wingy. I could bring in my calls a little bit. That'll smooth out my delta as well. All right. So that's how we're trading it. All right. Now, why do I not mind being a little bit short here? Well, the one thing to remember, you do this butterfly with other, for sure. Any underlying is fine for a butterfly. All right. So what I would kind of point out is look at the short vega. So this at onset looks bad, but take a look. All right, if we rally and volatility falls, I only lose a few thousand. I lose $4,000 instead of the 5 that it's expecting. Meanwhile, if we fall and volatility increases, I can lose. I lose, instead of making money, I lose money. All right, that's how that works. All right, so just some food for thought. All right, so now let's talk about picking a good fly. What makes a good butterfly? And the first piece is it starts with sinking or stable volatility. All right, I care about sinking realized volatility and stable or falling implied. And one thing to remember is that implied usually follows movement. When HV is sinking, so when movement is sinking, so is implied volatility. Sinking vol is the trade for and at the money butterfly. That is what you're looking for. So take a look. XLF. You know, I've got here a case where volatility is kind of sitting here, not really moving around. That's all right. Now, look at XLP. All right, which one appears to be kind of better for the butterfly? Well, I would argue XLP. And then you can see kind of the big difference between the implied volatilities. Right, my implied volatility in XLF moves around a lot. My XLP vol does not. It has less volatility in its volatility, and its volatility tends not to jump around that much. All right. XLP. IVs. All right, so there you really have it. All right, now let's talk about skew. Skew is defined as the relationship between calls that are out of the money relative puts that are out of the money. All right, this is what it looks like. Here's a picture. The downside of the curve, where those puts that we were looking at earlier exist, is really volatile. All right, how much calls increase and decrease is extremely volatile. All right, it moves around a lot. All right, so calls move less. All right, puts and equity options tend to get bid a lot. All right, and this tends to be the driver behind the vol curve for options. There tends to be more demand for hedging. All right, downside pressure in calls is caused by call writing. So if you look, you can see that kind of the space between the volatilities on calls in Apple relative to the puts is very different. All right, there is a lot of movement in the stuff that happens here, and then up here is where people slam. So let's kind of look at what really creates this trade. All right. So calls tend to be used as an overwrite. The 2400 calls in SPX, 9 vol. You can see, look at the tiny difference as we rally in these volatilities. Now, downside, so 2400, so 60 bucks away, we're talking 2280s. So if I pull this up, look at the different IVs. All right, look at the difference in Theo. These are both equidistant from the underlying, and there's a $20, $15 difference. $14.8, and then look at the spread between strikes. It's a lot more. So these downside curves tend to move a lot more. All right, so let me just kind of show you one more time how these things can be affected. All right, so I'm short at the money, I'm long here, and I'm long here on the curve. Right. If the curve moves like this, if a lot of people come in and hedge, all right, what I want you to notice is that when I do a curve fit like this, all right, so you get a bigger move out of puts than you do out of these little calls up here, right? Something with a big curve tends to move more. All right, there's a problem there. All right, if you are, if you're long this piece, you actually make money. If you're short it, you lose. So you're short strikes equally far away, and yet the calls lose money and the puts make money, but you as a net make money. That's the way skew curvature tends to move. So one of the keys to trading a butterfly is to understand that a flat skew curve, when downside puts are cheap, tends to be the better trade. That butterflies tend to make money when that's the case. So a fly can be set anywhere, but you want is really tight HV, not a lot of movement. You want falling implied volatility, and you want a flat skew curve. All right. So, any questions on how to build a butterfly? Any questions? All right. So, this method is not just for SPX. It's for NDX, any equity. So the question is $3 value for the call for every $1,000 index. No, it'd be $1.50 for every $1,000 index. But really, I like it to be worth at least $2.50, $2 generally anyway. So HV is trading in a tight range. Is that correct? Yeah. When HV is just when the underlying isn't moving very much. All right. And when it's been moving consistently at about the same rate. That's the key. All right, so now let's look at directional flies. We, and me especially, love directional flies. All right. There's slightly different characteristics, but not very much. If set up well, the fly will give the trader what he or she wants. Directional access, proper vague exposure, limited decay. All right, so when does one use a directional fly? All right, they want a cheap play, they want a play on volatility, and they want inexpensive gamma. All right, now, directional fly. All right, why would I set it up? One, I think the underlying is going to rally. All right, so if I feel super strong that an underlying is going to rally, I should buy a call or buy futures. One of the two. All right, if I feel somewhat strong, I would buy a bull call spread. Now, if I feel somewhat strong or a little strong, but I have a strong feeling on volatility, that's when I'm going to trade a butterfly. Pretty simple. So, what I want you to notice is how the gamma moves, all right? With this apple butterfly at onset, I'm long delta and long gamma, paying decay and long vega. Up 4% at 144. Well, I still have my long delta, but you can see I'm getting less long. And look at what happens to my position down at gamma, theta, and vega. What's happened? What's happened to my Greeks on this directional fly? All right. My Greeks flip. I go from the characteristics of a long spread or a long option to the characteristics of a short option. So when I set up a directional fly, all right, when I set up a directional fly, what I'm really looking for is movement and then stop. All right. I want my position at onset to act like it wants the underlying to move. And then after the position develops, I want it to act like a short gamma spread. All right. That's how that trade is set up. How I make my money on it. Right. So it starts, all right. It starts long options and converts into I don't want anything to happen. That's how a butterfly moves. It wants really kind of a little initial burst of movement or a slow swell of movement, followed by an utter and complete stoppage. And there you have it. Why does my fly love long gamma? Why does it have long gamma? Because it loves volatility. All right, so take a look. I'm setting up this Apple trade, and look at where these big drops happen. All right. All right. These drops follow moves higher. If I pull up a chart of Apple, which I'll do, I mean, if you look at the last 3 months, all right, these big drops are in volatility. They have movement. So I set up a butterfly here when we're 140. At the bottom, we're 141 and a half, and the IV has fallen to 1256 from 15. So I get a move, and I get a drop in implied volatility. I win both ways. So the beauty of this spread is that it's such a cheap way to be long gamma. I want the underlying to move my direction, but what if and I'm not paying a lot. But what if I'm wrong? What if I'm wrong? What do I do? And this is where the hedged fly comes in. And we do hedged flies and hedged calendars a lot. All right. We like flies, but why get married to direction? All right. If we rally, and we love bull flies versus long puts. All right. So if I am sure the stock is going to go up, I should buy calls. If I'm less sure, that is when the fly works. Thus, I should hedge my trade. If we rally, volatility is going to drop. If we tank, volatility is going to increase. So that's how I set up a spread that looks like this. All right. If the underlying rallies, if I get my little move, you can see the Greeks work to my favor. All right. Now, if I'm wrong, the subsequent increase in volatility allows me not to lose money on my butterfly. And this is a really simple butterfly. All right. All right. If vol is low and I have a lean on direction, but I'm not certain, I should trade my hedge fly. Hint, that's almost always. Vol is low, I have a lean on direction, but I'm not certain. All right. I should trade my fly. All right. If vol's low and I have a lean on in direction, but I'm not certain, so one has to think about what they're doing. All right. All right. So let's look at how to build a hedged fly real fast. All right. So let's look at Apple. All right. So I want to play the week ahead of earnings. It's a good time to be long. I've already got a position. All right. So I want to play earnings. I think Apple's going to drop and vol's going to come in. All right. So trading 140.68. I buy my 143 calls. And let's see. Right now on earnings, they're predicting about a $5 move. All right. So I'm actually going to set this up at 145. All right. So I'm going to set my initial long inside of the straddle. All right. I'm then going to sell my shorts outside of the straddle. All right. All right. Then finally, I've got my 145 calls. So here's my spread. 57 cents. That's cheap. There you have it. Now, I've got a decent delta. All I'm going to do is cut it. I've got 10 of these on. All I'm going to do is cut it down a little bit, and I could do it cheaply. All right. All right. All right. So I can buy, 3 of these 135 puts. And there you have it. That's kind of the way this thing looks. All right, so I'm now long gamma, long delta, long the underlying. All right, now what if I'm less sure on direction, but I'm sure vol is going to drop? If I think vol is going to go up, there are a ton of trades better than a fly. Straddle, strangle, long call spread. I should only trade flies if I want an inexpensive bet on a move, and unless I think vol is going to drop. All right. Now, if I think vol is going to drop a lot, and I think movement's going to die, then I'm going to look at a broken wing butterfly. A broken wing butterfly is a directional butterfly. All right. With different vega exposure. All right. Rather than being a touch long vega, a broken wing butterfly is actually short vega. So what a broken wing butterfly spread is where the strike furthest from the money is at a separate distance from the strike near the money. Essentially, it's a butterfly with longs at different distances. Now, the long can be that far long can be set closer, but it's usually set further away. So we like to set up a broken wing butterfly with the center strike at one strike beyond where we think the maximum move of the underlying could take it. All right. This is a trade that takes time, that is going to rely on slow movement. All right. In addition, there's a natural hedge, making buying extra options less than necessary. All right. So with a broken wing butterfly, the trader is looking for stocks that have been moving, vol is falling, they have good skew, and can attempt to grab a top. So here's USO. Look at that volatility. A top or a bottom. All right. Here's USO. And I'll build a broken wing butterfly here in a second. And here's a broken wing butterfly. It's a play on the underlying not dropping anymore and not getting hurt if it rallies. All right. So let me walk through a thought process here. All right. So let's set up a broken wing fly here. We'll do IBM. They got pounded today. Or Goldman. Look at Goldman. A little bit of a drop in vol. Vol's still pretty high. All right. I don't think Goldman's going to drop a lot more. And I think volatility is going to come in. All right. Here's how I might build that trade. So I buy 10 of the 205 puts in May, and I sell 20 of the 200s. So you can see that takes in 30 cents. All right, so then, if I wanted to keep a credit, I just buy the 185s. there is my broken butterfly. Now you're saying, Mark, that seems a little margin intensive. Yeah, but look at my risk on the upside. I have 0. It can rally as much as it wants, and I win. If I'm right and it takes a slow move lower, I'm in a position to absolutely kill it, especially if volatility comes in more. All right, where else this could be good is in like a name like Tesla. Tesla has been insane. Look at that volatility. No earnings coming up, just a crazy move, crazy short squeeze. All right. So I think Tesla's near a top. All right. What might I do? 305. All right. Well, what if I did a 325? 335? 260. I make a $2.60 credit. I could buy the 355s. And you can see it's got pretty nice Greeks. All right, so if Tesla has another short squeeze, I'm going to have problems. However, if Tesla stops moving, this trade's going to do great. All right, now alternative. I can use this as a cost reducer. All right, I think Tesla is going to tank. All right, I hate Tesla. All right, I do my 300 puts. I sell the 285s, and I buy the 275s. So you see, these are off strike. So there you go. This is cheaper than doing a straight put spread and has very similar characteristics. This is the alternative to a broke wing butterfly. And what I also like is that, again, it has good Vega exposure. All right. All right. One can do a few things. Managing broken wing butterfly. What we typically do is just slowly buy calls back. Or you can trade the stock. All right. Or you can, those are really the two best options. So in summary, these stocks are for high flyers. They aren't for high flyers. Aren't for premium sells. All right. All right. So I just want to thank everybody for coming. Oop. And we had offered a special deal on platinum the last time. I'm going to open that up for people that didn't get to see the recording. So we are going to offer a special on platinum. We've got our upcoming masterclass coming. That'll in early May. That'll be free. You get an extra 3 months of Option Pit Live. You get the gold course, silver course, Saturday classes, one-on-one time with me and Andrew, small group work with Andrew mostly and me. And there'll be a special price between now and, we'll say April 26th. So you have a week. Reach out to me if you're interested in the platinum, in signing up for platinum. And I want to thank everybody for coming, and I hope you enjoyed the course. All right, folks. think we finally did it. Have a great, any questions?